Every financial bubble starts with a promise that sounds reasonable, sensible, even patriotic. This one nearly broke an empire. In the early 1700s, Britain wasn't chasing greed. It was chasing survival. War had left the country drowning in debt. Taxes were already stretched thin, and the government needed a miracle that didn't look like one. No riots, no defaults, just a clever solution. Something modern, something financial. That's how the South Sea bubble begins. Not with madness, but with a spreadsheet. If that sounds familiar, it should. At the start of the 18th century, Britain was emerging as a global power, but it was also financially exhausted. Decades of war against France had left the state owing more than £30 million. In today's terms, that's hundreds of billions. The government was paying high interest just to keep the lights on. And worse, that debt was fragmented, owed to thousands of individuals, institutions, and funds, all demanding payment. Managing it was a nightmare. Then someone had an idea that felt elegant. What if the government could convert that messy debt into shares? What if creditors stopped being creditors and instead became investors? Not in the government, but in a company backed by the government. That company already existed. It was called the South Sea Company. On paper, it was a trading firm. It had been granted exclusive rights to trade with South America, then controlled almost entirely by Spain. In reality, that trade barely existed. Britain and Spain were often at war. Ships were blocked, ports were closed, profits were thin to non-existent, but the trade wasn't the point. The point was financial alchemy. In 1711, the South Sea Company proposed a deal. It would take over a large portion of Britain's national debt. In exchange, debt holders would receive shares in the company. The government would pay the company interest instead of paying thousands of creditors directly. The company, meanwhile, would promise investors riches from future South American trade. Everyone seemed to win. The government simplified its debt. Politicians kicked the problem down the road, and investors got a stock with an implicit government guarantee and the dream of exotic profits overseas. Here's the uncomfortable truth. The South Sea Company didn't need to succeed as a business. It only needed its stock price to rise. And that's where things quietly changed. At first, the plan worked. Shares traded steadily, confidence grew. The company's directors, many of whom were politically connected, began to realize something important. The less attention people paid to actual trade revenues, the more attention they paid to the stock itself. So the company leaned into that. In 1720, the South Sea Company made an audacious proposal. It offered to absorb almost all of Britain's remaining national debt, over £30 million worth. In return, it would issue even more shares. Parliament approved it. The king endorsed it. Members of Parliament were quietly offered discounted stock. This wasn't a side hustle. This was state-sponsored optimism. The mechanics were simple, but dangerous. Debt holders were encouraged, sometimes pressured, to swap their government bonds for South Sea shares. The higher the share price climbed, the more attractive the swap became. And the more debt the company absorbed, the more important it became to the entire financial system. The stock price began to rise. Slowly at first, then faster. £100 became £200, £300, £400. Every increase felt like proof. Proof that the company was sound. Proof that Britain had engineered a new kind of financial machine, one that could turn debt into prosperity. But beneath the celebration was a problem no one wanted to look at too closely. The company's profits from actual trade were tiny, almost irrelevant. There were no fleets returning from South America loaded with silver, no surge in real economic activity. The company was paying dividends not from earnings, but from new investors' money and government interest payments. This wasn't trade, it was circulation, and circulation feels a lot like growth, until it doesn't. As the share price climbed, a new phenomenon appeared across London. Imitators. Entrepreneurs with no real businesses began launching joint stock companies of their own. Some were vague, some were absurd. One famously advertised, "A company for carrying on an undertaking of great advantage, but nobody to know what it is." People still invested. Why? Because prices kept going up. This wasn't just aristocrats and bankers anymore. Shopkeepers, clerks, widows, servants pooling savings. Everyone had a story about someone who doubled their money in weeks. Coffee houses turned into trading floors. Rumors moved markets faster than facts ever could. And crucially, the South Sea Company encouraged it. Its directors lent money to investors so they could buy more shares. They manipulated supply. They timed announcements. They talked about future riches just out of reach. New treaties, new ports, new monopolies. Always just ahead. By the spring of 1720, the stock passed £500, then £600. At this point, the math was already broken. To justify the valuation, the company would have needed profits greater than the entire British economy's overseas trade, but valuation no longer came from earnings. It came from belief. And belief, when reinforced by government approval and rising prices, becomes contagious. Even Isaac Newton bought shares. He sold early, made a tidy profit, and famously said he could calculate the motions of heavenly bodies, but not the madness of people. Then he bought back in at a much higher price, because everyone else was getting rich. By June, South Sea shares approached £900, and beneath the noise, beneath the optimism, beneath the applause, a quiet question began to surface, one that no one wanted to answer just yet. What happens if the price stops rising? By the summer of 1720, that question had become dangerous, not because it was wrong, but because the entire system depended on nobody asking it out loud. At nearly £1,000 per share, the South Sea Company was now worth more than any business Britain had ever seen. On paper, it was richer than the Bank of England, richer than the East India Company, richer, arguably, than the country backing it, and yet nothing fundamental had changed. No new trade routes had opened, no flood of silver arrived from South America. Spain hadn't suddenly become friendly. The company's revenues were still thin, its business still largely theoretical. The only thing that had grown was the expectation that the price would keep climbing. But expectations are fragile. It didn't take a dramatic trigger, no single catastrophe, just a subtle shift. A few large investors, company insiders, foreign holders, people close enough to see the imbalance, began to sell quietly. They didn't announce it. They didn't panic. They simply converted paper gains into something real. The price wobbled. For months, any dip had been met with eager buying. This time, the rebound was slower. Buyers hesitated. Sellers grew impatient. Rumors spread, not of opportunity, but of exits. And once belief cracks, it doesn't crack evenly. By August, the share price slipped below £800, then £700. Investors who had borrowed money to buy shares suddenly faced margin calls. They were forced to sell to repay loans. Selling pushed prices lower. Lower prices triggered more forced selling. The circulation reversed. Within weeks, the stock collapsed. £900 became £500, then £300, then under £200. Fortunes evaporated faster than they had been made. People who thought they were wealthy discovered they were deeply in debt. Savings vanished, pensions disappeared, entire family estates were wiped out. The psychological shock was immense. This wasn't just a market downturn. This was the failure of something that had been presented as safe, patriotic, government-backed. People hadn't just invested money, they had invested trust. Anger followed quickly. Parliament launched investigations. Pamphlets circulated accusing the South Sea Company's directors of fraud and corruption. Evidence emerged of insider dealing, bribery, and manipulation at the highest levels. Members of Parliament had been given stock options. Ministers had promoted the scheme while quietly cashing out. The line between government and speculation had blurred completely, and now everyone could see it. Some directors were arrested, others fled. Estates were confiscated. One prominent figure was stripped of nearly all his wealth to compensate victims. It looked briefly like accountability. But there was a deeper problem no punishment could solve. The British financial system had nearly collapsed alongside the company. Banks were exposed. Credit froze. Confidence in joint stock companies evaporated overnight. Investment, which had been surging, came to a halt. The very mechanism Britain had hoped would modernize its economy suddenly looked like a threat to social order. So Parliament did what governments often do after financial disasters. It changed the rules. The Bubble Act was passed, severely restricting the creation of joint stock companies without royal charter. Innovation slowed. Risk-taking retreated. For decades, Britain's corporate landscape became cautious, controlled, almost suspicious of growth itself. In trying to save the system, they froze it. And here's the irony. The South Sea bubble didn't fail because markets were unregulated. It failed because they were selectively regulated, because political power was used to promote one narrative while suppressing others, because risk was socialized and reward was privatized long before those phrases existed. The company wasn't a rogue actor operating in the shadows. It was operating in plain sight, with royal approval, parliamentary support, and public celebration. That's what made it so dangerous. This wasn't greed versus morality, it was structure versus reality. A system where rising prices became proof of truth, where financial engineering replaced productive activity, where confidence was mistaken for value. And that pattern didn't end in 1720. You see it every time debt is repackaged as opportunity, every time complexity is sold as sophistication, every time a system becomes too politically important to question honestly. The South Sea bubble is often remembered as a historical curiosity, a bizarre moment of collective insanity. But that framing is comforting. It lets us believe we're smarter now, more informed, better protected. History suggests otherwise. The people who invested weren't fools. They were responding rationally to incentives placed in front of them: government endorsement, rising prices, social proof, easy credit, limited downside, until suddenly there wasn't. The mechanics haven't changed much, only the names have. Today, bubbles don't always announce themselves with absurd company prospectuses or coffeehouse rumors. They arrive dressed as innovation, stability, policy, safety. They grow slowly, then all at once, fueled by the same quiet assumption that tomorrow will justify today. And when they break, the damage is never evenly distributed. Some people exit early, most don't, and afterward, the story is rewritten to make the outcome feel inevitable. But it never feels inevitable at the time. Standing in London in early 1720, watching South Sea shares climb, it probably felt like Britain had outsmarted history, that it had found a way to turn debt into prosperity, belief into wealth. And for a moment, it worked, which raises an unsettling question. If the South Sea bubble was built on reasonable ideas, pushed just a little too far, how confident are we that we'd recognize the next one while we're still inside it?